Something changed for seniors this year, and most people have not heard about it yet. A retirement deduction could shield up to $47,500 of your income from federal taxes, but sitting right beside it is a Medicare penalty quietly billing some retirees an extra $300 or more every single month. These two forces are directly connected, and the wrong move on one side can erase every dollar you gained on the other. This matters to you right now if you are 65 or older, approaching Medicare age, or making retirement financial decisions in the next 1 to 2 years. If staying ahead of retirement rules, Medicare changes, and tax updates feels like running after a moving train, this channel is the one that runs with you. Every update that affects your money gets broken down here, and this video is exactly the kind of protection you deserve to have in your corner. Hit subscribe right now, because what you learn here could be the difference between keeping hundreds of dollars a month and quietly losing them without knowing why. Ring the bell too, so you never miss the next one. Your future self will thank you. Here's what you are getting today. You will understand exactly how that $47,500 deduction is constructed, who it actually applies to, and what the catch is that most people never hear about. Then we are walking through the Medicare surcharge system that has been quietly draining retirement budgets for years, why it keeps catching retirees completely off guard, and what real options exist to fight back against it. There is also one small detail buried inside the income thresholds that almost everyone overlooks, and once you see it, it changes how you approach both topics entirely. We will circle back to it at exactly the right moment, so stay with me. Let me be honest with you about why this matters so much. You have spent years saving. You paid into the system through every working decade. And the moment you begin drawing on that money, a set of rules most people never learned about can reach in and take more than expected. This is not a scare tactic. It is what quietly happens to thousands of retirees every year, and it keeps happening because most content covers only one half of the picture. You get the deduction news with no warning, or the Medicare warning with no solution. Today we are covering both in the right order, with no piece missing. Let us start with Medicare, because that is the side that tends to shock people the most when they finally understand it. When you enroll at 65, you pay a monthly premium for Part B, which covers doctor visits and outpatient care, and a separate premium for Part D, which covers your prescription drugs. Most people assume those amounts are the same for everyone, like a flat fee everyone pays equally. That assumption is not correct. If your income exceeds certain levels, Medicare adds a surcharge on top of your base premium, and the amount of that surcharge can be jaw-dropping for someone who never saw it coming. The surcharge system has a name, IRMA. That stands for Income-Related Monthly Adjustment Amount. Here is the part that catches everyone by surprise. Medicare does not look at what you are earning right now to set your premiums. It looks at what you earned 2 years ago. For your 2026 Medicare costs, the number being used is from your 2024 tax return. Whatever income you reported in 2024, whether you still earn that much today or not, is what is driving what you pay right now. That 2-year gap between what you earned then and what you owe now is the exact location where the trap snaps shut. Picture this. You worked all the way through 2024, bringing in around $108,000 between your job and a small pension. You retired at the end of that year, feeling good about the transition. By 2026, your retirement income from Social Security and modest withdrawals totals roughly $44,000, which is a comfortable and sustainable amount. But Medicare is not looking at that $44,000. It is looking at 2024, and it sees $108,000. Your monthly premiums in 2026 are calculated against an income figure you no longer have and may never have again. That difference shows up in your bill every single month without a single word of explanation. Here is where the dollar amounts become very real. The standard Part B premium in 2026 is $185 per month. That is the baseline most lower-income beneficiaries pay. But once your 2024 income crossed the first threshold for your filing status, Medicare begins layering surcharges on top. At the first tier, you are looking at roughly $74 more per month on top of that base amount. That alone adds up to nearly $900 extra per year, just for Part B. Move into the second surcharge tier, and that monthly addition roughly doubles. Each tier above that continues climbing, and the system never phases in gently. It hits all at once the moment you cross the line. Now I want to come back to that detail I promised you, because this is the one that almost no one talks about, and it is the one that costs people the most money. The IRMA surcharge does not ease in gradually like a tax bracket does. It works like a cliff. You are either below the threshold or you are over it. And the instant your income crosses that line by even $1, you pay the full surcharge for that entire tier. One extra dollar of income in 2024 can mean hundreds of dollars more in Medicare premiums throughout 2026. That is not an exaggeration. That is the literal math. And understanding exactly where each cliff sits is the difference between smart planning and a very expensive surprise. Part D has its own separate surcharge structure added on top of everything else. So if your income triggers surcharges on both Part B and Part D simultaneously, you are paying extra on two fronts. For a married couple where both spouses are on Medicare, each person pays their surcharges separately. That is how a household can end up paying a combined $300 or more in extra monthly premiums compared to a lower income couple in the same program. That $300 figure is not an extreme edge case. It is a very real outcome for couples landing in the middle income surcharge tiers. Let me make this tangible with a real feeling example and actual numbers. Meet Linda, a 68-year-old retired registered nurse filing as a single person. In 2024, her last full working year, she earned $118,000 from her salary and a small pension distribution. She retired that December and expected her Medicare premiums going forward to be around the standard amount. But her 2024 income placed her solidly in the first IRMA surcharge bracket. Her Part B premium jumped by approximately $74 per month. Her Part D coverage added another $13 on top of that. Linda is now paying $87 more every single month, which adds up to over $1,000 in additional premium costs per year that were never in her retirement budget and that no one warned her were coming. Before we keep going, here is something worth pausing on. Do you actually know what income year Medicare is currently using to calculate your premiums? And do you know whether that number is putting you in a surcharge bracket right now? Most people have never checked. If you have not, is this the week you finally do? Here is what most retirees never find out. If your income dropped significantly because of a qualifying life event, you have a right to appeal. Retirement itself is one of those qualifying events. So is losing a spouse, losing a pension, or experiencing a major reduction in household income through other circumstances. There is a process where you can file with Social Security to ask them to base your current premiums on your current income, rather than the 2-year-old number they are using. When that request is approved, it can reduce or entirely eliminate the surcharge. The savings can be substantial, sometimes hundreds of dollars every month. But you have to know the option exists, and you have to take the step of pursuing it. Most people never do, because no one ever told them it was available. A quick but important note about protecting yourself during this process. Legitimate government agencies will not call you out of nowhere asking you to confirm your banking details or provide a code to verify your Medicare account. If you receive an unexpected call about your premiums or your IRMA appeal, hang up and call back using the official number printed on your Medicare card or your most recent statement. Do not trust caller ID, do not click links in unfamiliar messages, and never provide codes or account numbers over the phone to someone who contacted you first. Fraudsters target retirees specifically during these kinds of financial updates. Now let us turn to the opportunity side of this because the deduction is real and it is worth understanding clearly. Starting with the 2025 tax year and running through 2028, eligible seniors can access a stacked structure of federal deductions that meaningfully lowers taxable income. For a married couple where both spouses are 65 or older, filing jointly, those layers combine to reach $47,500. That headline number is accurate, but it only applies to a specific filing situation under specific income conditions. Understanding each layer helps you know whether it applies to you fully, partially, or not at all. Here is how it is built. Every married couple filing jointly starts with the standard deduction. For 2026, that base amount is $32,200. That is the foundation available to everyone regardless of age. On top of that sits the additional standard deduction that has long existed for taxpayers who are 65 or older. For 2026, each qualifying spouse adds $1,650. For a couple where both are 65 or older, that layer contributes $3,300. Then a newer temporary law introduced a bonus deduction of $6,000 per eligible senior. For a qualifying couple, that adds $12,000 more. Add those three layers, $32,200 plus $3,300 plus $12,000, and you reach $47,500. That is the math. And now you understand exactly where the number comes from instead of just seeing it in a headline. For single filers, the total is meaningfully lower and worth knowing clearly. The 2026 standard deduction for single taxpayers is $1,600. The additional deduction for being 65 or older is $1,650. With the $6,000 bonus added, the combined total for a single senior comes to $23,750. That is still a real and valuable reduction in taxable income. But it is a completely different number from $47,500, and single retirees deserve to plan around their actual figure rather than one that belongs to a married couple's tax return. Here is the second detail most people miss, and it could directly affect how much of this benefit you actually see. The newer bonus deduction does not flow equally to everyone. It begins phasing out once your modified adjusted gross income climbs above $75,000 for a single filer, or above $150,000 for a married couple filing jointly. As your income rises past those levels, the bonus shrinks. Above a certain point, it disappears entirely. If your retirement income lands comfortably below those thresholds, the full benefit is likely yours. But if you are above them, your actual usable deduction is lower than the headline number suggests, and planning around a figure that does not apply to you leads to real errors in your retirement math. Let me walk you through a second example to show how these two systems can collide in a way most people never anticipate. Raymond and Dorothy are both 67, married, and filing jointly. Their combined 2026 income from Social Security, a small pension, and regular IRA withdrawals is about $92,000 a year. That amount keeps them under the married ERMAA threshold, so they are not paying any Medicare surcharges. Their income is also under the bonus deduction phase-out range, so they can claim the full $47,500 combined deduction structure. Their tax picture looks solid. Now consider the twist. Back in 2024, they sold a rental property they had owned for decades, and that sale created $140,000 in taxable capital gains. Their 2024 income, as a result, jumped to $232,000 for that 1 year. In 2026, their income is back to normal, but Medicare is looking at 2024. That property sale 2 years ago is now pushing them into an ERMAA surcharge bracket, and they are paying hundreds of dollars a month in extra Medicare premiums that their current income would never have triggered. The deduction is still available to them on the tax side, but the surcharge on the Medicare side is quietly consuming a large portion of what the deduction was supposed to save. There is a belief about IRMA that I want to address directly because it is widespread and it is costing people money. Many retirees believe that once they are living on a fixed retirement income, Medicare surcharges are simply not something they need to think about. The assumption is that surcharges are a problem for wealthy people, not for ordinary seniors trying to make their savings last. That assumption is wrong. IRMA does not target ongoing wealth. It targets a single year's income from 2 years ago, one large IRA withdrawal, one home or property sale, one Roth conversion done at the wrong scale, or one final year of full-time employment before retiring can send a single year's income over a threshold. 2 years later, the surcharge appears in your Medicare bill with no explanation attached and no warning that it was coming. Regular people walk into this trap all the time because no one told them about the cliff, and no one told them their 2024 decisions would follow them into 2026. You have made it this far, and that tells me you are serious about protecting your retirement. So here is something I genuinely want to know. Of everything we have covered so far, which piece landed as the biggest surprise for you? And is there someone in your life who also needs to hear this? Drop it in the comments below and share this with them today. Now let us talk about the most common mistakes, because these are the ones that cost real people real money every single year. These are not hypothetical errors. They show up repeatedly, and knowing about them before you make them is the entire point. The first mistake is taking a large retirement account withdrawal all in one calendar year without thinking about what that does to Medicare premiums 2 years down the road. People have completely valid reasons for doing this. Home repairs, car replacements, medical bills, helping family members, but that one large withdrawal raises the income reported on that year's return, and Medicare uses that number to determine your premiums 2 years later. Spreading the same withdrawal across 2 calendar years can sometimes keep you under a surcharge threshold entirely, at no actual cost to you. The second mistake is treating the $47,500 deduction as though it automatically applies to your specific situation in full. It only reaches that amount for a married couple where both spouses are 65 or older, filing jointly with income under the phase-out range. Single filers have a different and lower total. Couples where only one spouse is 65 get a partial senior bonus. Higher income households may see the bonus layer reduced or eliminated. Calculating your actual number, rather than assuming the headline figure applies to you, is the move that protects you from planning around money you may not actually get. The third mistake is not knowing that you can request a review of your surcharge when your income falls. Retirees who retire mid-year, lose a spouse, or experience a sudden reduction in household income are often still paying higher surcharges simply because no one informed them that an appeal was available. The process requires documentation and a formal request, but the potential savings make every bit of that effort worthwhile. If your situation has changed since the income year Medicare is currently using for your premium calculation, look into whether a qualifying life event gives you grounds to request a recalculation. The fourth mistake is doing a large Roth conversion in a single year without modeling what that income addition does to your Medicare bill 2 years ahead. Roth conversions are a legitimate and often smart long-term strategy. The issue is purely one of timing and scale. The income you add in a conversion year counts toward your modified adjusted gross income, which is exactly what IRMA uses. A single large conversion can push you over a surcharge cliff. Spreading the same conversion across several smaller annual amounts, staying just under the relevant threshold each year, achieves the same long-term benefit without triggering the penalty. The fifth mistake is forgetting that capital gains count toward the RMAA calculation. Many retirees think about investment gains and asset sale proceeds as being in a separate financial category from regular income. For IRMAA purposes, they are not. When you sell appreciated stock, a rental property, a vacation home, or any other asset, those gains typically count toward your modified adjusted gross income. If that total crosses a surcharge threshold in a given year, the extra Medicare cost arrives 2 years later, often so far removed in time from the original sale that the connection is not obvious. Timing significant asset sales with the IRMA 2-year window in mind gives you a layer of control most retirees never think to use. Here is a direct question before we move on. Is there a specific financial move in your near-term retirement plan that you have never once run through a 2-year IRMA lens? If the answer is yes, what would change about that decision if you did? Let us talk about 3 specific situations so you can place yourself clearly in the picture. If you are between 62 and 64 right now, whether still working, partly retired, or actively planning your exit, you are sitting in the most powerful planning window available. The income decisions you make in the next 1 to 3 years will directly set your Medicare premiums when you turn 65. You have time to be deliberate about which years carry higher income, when to execute withdrawals, and how to spread out Roth conversions so they stay below the surcharge cliffs. The further out you plan, the more you control. Waiting until you are already enrolled removes most of your options. If you are already on Medicare and recently received a notice showing that your monthly premium is higher than the standard amount, the first thing to do is not panic. Identify which income year is being used to calculate your surcharge. Then look at what your actual current income is. If there has been a significant drop because you retired, experienced a loss, or had income from a one-time event that year, you may have grounds to request that Medicare use a more current income figure instead. That request requires documentation and follow-through, but for retirees whose income is now genuinely lower, it can produce real monthly savings without requiring any change to how they are living. If you are 70 or older and required minimum distributions have already begun from your traditional retirement accounts, IRMAA is not a one-time concern for you. It is an annual variable in your financial picture. Those distributions increase your taxable and modified adjusted gross income every year, and for retirees who saved heavily in tax-deferred accounts throughout their careers, the required amounts can be large enough to push them into a surcharge bracket year after year. Understanding exactly which tier you currently occupy and building your annual income strategy around it is how you keep that Medicare cost as low as possible given your circumstances. Here is something that ties all of this together and that most content on this subject never mentions. The deduction and the surcharge do not run on the same math. Tax deductions reduce your taxable income, which lowers your federal tax bill. But IRMA is calculated on your modified adjusted gross income, which is typically a larger number because it is measured before many deductions are subtracted. This means you can be claiming every deduction available to you, including the full $47,500 stacked amount, and still be subject to an IRMA surcharge at the same time. You might save $1,200 on your taxes through the deductions while paying $2,000 extra on the Medicare side through the surcharge. The net result is a loss, even though the headline was about how much you saved. Seeing both calculations simultaneously is the only way to know whether you are actually coming out ahead. Here is something practical you can do today to get a real picture of where you stand. Pull up your 2024 federal tax return and locate your modified adjusted gross income, which typically appears on the first page of your Form 1040. Compare that number to the IRMA income thresholds for your filing status and see whether you are below, near, or above one of the bracket lines. If your 2024 income was higher than usual, note what drove it up: employment income, a large withdrawal, a property sale, a conversion. Then look at your 2025 income the same way, because that year determines your 2027 Medicare premiums. If you are 65 or older, confirm with a qualified tax professional that you are positioned to claim all three layers of the 2026 deduction structure, and that your income does not place you in the bonus phase-out range. If you are currently on Medicare, and your income has dropped meaningfully from the year being used to calculate your surcharge, look into whether a qualifying life event gives you grounds to request a premium review. Finally, before you execute any significant financial move this year or next, model the IRMA impact 2 years ahead before you commit. Let me bring everything together clearly so nothing is left in the air. There is a real and meaningful deduction available to eligible seniors in 2026, stacked from 3 separate layers that total up to $47,500 for a qualifying married couple filing jointly where both spouses are 65 or older. Single filers have a different and lower total. The bonus layer is temporary and phases out at higher income levels. At the same time, Medicare's IRMA surcharge system adds extra monthly costs to your premiums based on income from 2 years ago, using a cliff structure that delivers the full surcharge the instant your income crosses a threshold. These two systems operate in parallel, they interact with each other, and you cannot optimize one without understanding how it affects the other. The only way to make genuinely good decisions in this environment is to see both sides of the equation at the same time. Here's the final thing I want to leave with you. The greatest financial danger in retirement is not a sudden market drop or an unexpected medical bill, though both of those are serious. It is the quiet, invisible drain that runs in the background month after month because a decision made years ago is still following you forward. The IRMA surcharge is exactly that kind of drain. It does not announce itself loudly. It shows up as a line on a premium notice and keeps pulling from your budget for 12 months at a time, year after year. But here is the truth that matters most. Now that you see this system clearly, you are no longer walking through it blindly. You can time your income, plan around the cliffs, appeal when your circumstances qualify, and make every major financial decision with the 2-year ripple effect already in view. The rules are the same as they were before you watched this video, but your ability to navigate them just changed completely. So here's the question I want you to carry forward. Knowing everything you just learned today, what is the very first retirement decision you are going to revisit before you make it?